Meta was on fire, record revenues, booming AI investments, and then suddenly the stock dropped hard. What happened? Did Meta make a critical mistake? And most importantly, should we be buying this dip or is this just the beginning of a bigger fall? Before we dive in, this video is not financial advice. Everything you'll hear is based on publicly available information and personal analysis. Always do your own research before making any investment decisions. Let's start with the facts. Meta just posted its third quarter earnings and reported around $51.2 billion in revenue, which is a strong 26% year-over-year growth. That means the company's ad business, the core engine behind Meta, Cinergy, is still performing extremely well. However, things got messy when we looked at profits. Meta's GAAP net income dropped significantly because of a one-time non-cash tax provision of roughly $15.9 billion. On an adjusted basis, the company still made strong profits, about $7.25 per share, but GAAP earnings looked weak, and that alone spooked the markets. So in short, strong growth, solid underlying profit, but a complicated headline number that confused investors. Reason number one for the drop, that massive tax provision. Meta had to take a $15.9 billion accounting hit tied to recent U.S. tax legislation. It's important to understand that this wasn't real cash leaving the company. It was a non-cash accounting adjustment that affects GAAP earnings. Unfortunately, most trading algorithms and some investors only look at the GAAP numbers. When they saw earnings collapse on paper, automatic sell triggers were activated, leading to a fast downward spiral in the stock price. So, while nothing fundamental about Meta's business changed overnight, the headline earnings miss created panic. This is a classic case of how accounting can move markets, even when the underlying cash flow remains strong. Next up, reason number two, and probably the biggest concern among analysts, AI spending. Meta announced it will significantly increase capital expenditures to build new data centers and purchase specialized AI chips. The company's full-year capital expenditure is now expected to hit $70 to $72 billion, and Meta also warned that expenses in 2026 will be materially higher as it continues to scale AI infrastructure. This triggered a classic investor worry: rising costs now, uncertain payback later. Even if AI investment is essential for the company's future, especially for recommendation algorithms, ads, and generative products, markets hate uncertainty. That's why some analysts downgraded the stock and cut their price targets. The fear isn't that AI will fail, it's that Meta's AI bill will balloon before the revenue follows. Reason number three, the ongoing Reality Labs problem. Meta's virtual and augmented reality division continues to post multi-billion-dollar losses each quarter. While Meta sees it as a long-term bet on the future of computing, investors are losing patience. Every dollar poured into Reality Labs is a dollar not returning immediate profit. Combine that with the heavy spending on AI, and you get an image of a company investing everywhere at once, without short-term financial returns to show for it. So, while the ad business is strong, the heavy R&D spending across Reality Labs and AI infrastructure makes investors nervous about near-term profitability. The market reaction was brutal. After the earnings release, Meta's shares fell double digits in after-hours trading. Some hedge funds and analysts quickly revised price targets downward, citing margin compression and uncertainty about future returns. This is typical of post-earnings volatility. Investors digest the headline numbers, react emotionally, and only later realize what's actually behind them. Still, such a steep drop signals real concern that Meta's profit margins could shrink if expenses continue to rise faster than revenue. Here's the other side of the story, and the fundamentals are still impressive. Meta's family of apps, including Facebook, Instagram, WhatsApp, and Threads, continues to grow engagement. Daily active users are in the billions, and ad revenue is climbing strongly. In fact, ad impressions were up, and average price per ad also increased, which means advertisers are confident in Meta's targeting and performance. Meta's AI-driven recommendation engine is keeping users engaged longer, and Reels, one that once seen as a drag on profit, Wix is now improving monetization. So while expenses are rising, the core engine is still generating enormous cash flow, giving Meta the flexibility to fund these large AI and VR projects. So how do we value Meta right now? There are two clear scenarios. Scenario one, the cautious view. Meta's rising CapEx and Reality Labs losses keep margins under pressure, leading to slower earnings growth and potentially lower valuation multiples. In this case, the stock could stay volatile or even fall further if markets think spending is out of control. Scenario 2. The optimistic view. Meta's AI investments start paying off within 2 to 4 years. improving ad efficiency, creating new revenue streams, and maybe even monetizing its AI tools. That could push revenue and margins back up, justifying today's heavy spending. Both scenarios depend on assumptions. So if you believe Meta can turn AI infrastructure into high margin business outcomes soon, the dip might be a buying opportunity. If you're skeptical, you may prefer to wait for clear results in the next few quarters. So, what should investors do with all this information? First, separate accounting noise from operational performance. The one time tax charge distorted GAAP numbers, but the real business remained strong. Second, recognize the time horizon. Meta's AI investments could take years to fully monetize, so if you're looking for quick gains, this might not be the right moment. Third, manage your exposure. With so many moving parts, reality labs, AI capex, regulation, ad trends, it's smart to keep position sizes reasonable and reevaluate after the next 2 quarters. In short, understand what you're buying. A long-term AI-driven ad platform that's currently in a heavy spending phase. So, should we buy Meta now? The recent dip was caused by a mix of accounting confusion and forward-looking spending fears, not by a collapse in the core business. Meta is still growing revenues, dominating social platforms, and generating billions in operating cash. But this is also a company making massive long-term bets on AI, on the metaverse, on future advertising formats. That means short-term volatility is guaranteed. So, if you believe in Meta's AI future and can handle the ups and downs, this could be a smart moment to start accumulating. If you need stability and short-term profits, waiting for more evidence might be the wiser move. Either way, base your decisions on facts, not fear.